Hi, I'm Lindsay Bennett, healthcare executive, and nobody is teaching what I'm about to show you in this video. Revenue cycle directors rarely know how their actions impact all three of the financial statements: the balance sheet, the income statement, and the statement of cash flows. They can't trace a change in denials all the way through to those three statements. And similarly, on the other side, finance and accounting professionals rarely know what is happening within revenue cycle that is moving the numbers in those financial statements that they report. Both sides are essentially missing the same map, but nobody's building a bridge between these two worlds. In this video, I'm going to walk you through a very specific example of how a 2% change in the denial rate at a hospital flows through to the balance sheet, the income statement, and the statement of cash flows. I'm going to walk you through the logic and the math. And at the end, I'm going to give you a spreadsheet with some calculations. But for that to make sense, hang around for this video so I can walk you through it.
Let's start with the impact to the income statement of a 2% increase in the overall denial rate for a hospital with $350 million in net patient revenue. I'm going to show you the math behind this in just a moment, but the impact is going to be a negative $2.8 million to net patient revenue, an additional $38,500 in incremental labor costs associated with having to work the additional denials, and an increase in interest expense of $51,800 from having to take money on a line of credit while you have all these denials tied up in accounts receivable. And if you add up these three cards, the total net income impact is negative $2.89 million. Now, how did I get to that number? Let's take a look. Here we have the denial rate for this hospital at 7% before the 2% increase. Then afterwards, the denial rate has gone up to 9%. So if we take 7% times that $350 million a year in revenue, that gives us $24.5 million of revenue that is denied. Then if we take the 9% denial rate times the $350 million in annual revenue, we get $31.5 million of revenue impacted. And the difference between those two is $7 million. Now, not every denial is going to be a permanent loss of revenue because in some cases you can appeal. So we are going to assume in this example that 60% of these denials are going to ultimately be recoverable. So that means that 40% of the 24.5 million and 40% of the 31.5 million are going to represent permanently lost revenue. So under the current scenario at 7%, that's a $9.8 million loss. But if we increase the denials by 2%, that $9.8 million is increasing to $12.6 million. And that's where we got our $2.8 million hit to our net revenue and to our operating margin on the income statement. Now let's look at the salaries and wages expense line item on the income statement. Because when we have all these additional denials, now somebody has to go work those denials. So if we take the 2% increase in the denial rate times the $350 million a year in revenue, and we take the result divided by our average claim value, which for this example, we're going to just assume is $10,000 a claim, that gives you an approximation of the number of claims that are denied in this 2% increase. Then we can take that number of claims times the average cost to work a denial. And in this example, we're using $55 per claim, which is about the middle of a range that's a common industry benchmark. So if we do the math on that, then we end up with incremental labor expenses of $38,500 associated with working those additional claims. Now, one thing that's not accounted for here is that if you're doing this with your existing staff, you might even be paying time and a half for overtime to work these additional denials. Now let's look at the interest expense line item on the income statement, because we're going to assume in this example that while these denials are held up being worked, then you don't have cash in the bank. And so if this hospital is distressed and doesn't have a lot of cash on hand, then it might have to go and borrow on a line of credit. So we're going to calculate the cost of that by taking the difference in the impacted revenue at the 7% denial rate and again at the 9% denial rate. And remember, the difference there is $7 million. Now we're going to say that we have a portion of that that is recoverable. That's the 60%, which is $4.2 million. And we're going to assume that that is sitting in your accounts receivable being worked by collectors for 90 days. And that's the 90 days that you're not going to have that cash. So if you're borrowing on a line of credit at a 5% interest rate, the 90 days divided by 365 days a year to prorate it, that comes out to be $51,800 in interest expense. Now let's look at the impact on the statement of cash flows. So remember, your net income changed by $2.89 million, and that was because of the permanently lost revenue, the additional labor expense, and the additional interest expense. So that's going to show up on your statement of cash flows as your change in net income. Then you have your increase in accounts receivable. This is the portion of that 7 million difference when you went from 7% to a 9% denial rate. This is that 60% of that 7 million or 4.2 million. And on your statement of cash flows, that is going to be shown as an increase in your accounts receivable, which on the statement of cash flows is a decrease in cash. Then we have the proceeds from the line of credit. And for this example, just to keep it simple, we're going to assume that you're borrowing that whole 4.2 million. That is going to appear under the financing activities as proceeds from the line of credit. And then finally, you have your balance sheet impact. So on the balance sheet, we're going to see the 4.2 million increase in the accounts receivable line item. We're going to see the 2.8 million of permanently lost revenue. This is the part that is denied, that is not going to be recovered upon appeal. So that is going to appear in your allowance for doubtful accounts, or your reserves. And then you're going to see the net income loss appear again in the equity as a reduction of $2.89 million in equity. And then our line of credit borrowing is going to increase our liabilities on the balance sheet. And then you have a revenue cycle KPI, which is the days in accounts receivable. So if we take that 4.2 million change in the accounts receivable balance divided by the average daily revenue, what that's going to do is it is ultimately going to add 4.4 days to our days in AR. That is how many additional days of revenue are going to be hung up by being in the appeals pipeline.
If you found this video helpful, please take a moment to like and subscribe and make sure that you are getting notifications, because I'm going to go through some other examples of changes in revenue cycle and how they flow through the financial statements. You can also find a sign up for my free email list in the description, which is where I share free tools and templates, which I think you'll find a lot of value in.